Okay, I can see participants joining. If you can hear me, just say yes on the chat window. Okay, it is 12 o'clock now. We will wait for a couple of minutes more and then we will start this webinar. Okay, I can see yes, sir, from the participants, which means you can hear me. If you can hear me loud, please say yes. Just a moment. Is it loud now? Can you hear me? हेलो हाँ जी अभी देखो आवाज़ आ रहा है अच्छा, आवाज़ कम आ रहा है यस सर बोल रहे हैं यहाँ पे विच मीन्स वॉइस यस सर आ रहा है यहाँ पे कमेंट्स में ओके क्या करो अभी चलो स्टार्ट करते हैं वेबिनार है ना अभी देखो अभी आवाज़ सुनो आवाज़ आ रहा है हेलो जस्ट अ सेकेंड okay if everybody can hear me loud and clear please say yes so that we can start this webinar. Okay, it's clear now. Okay, we'll start this webinar. The time frame of the webinar would be around 40-45 minutes and then we'll proceed towards the Q&A. Okay, let us start now. The main intention of this webinar is to tell our participants that whether it is the right time to buy gold this Diwali or not. And yes, the main intent is that whether this is the right price to purchase gold, yes or no, and then the content of the webinar would be focused on this particular topics, wherein we will be talking about why gold as an asset class is important, what are some of the basics of gold market, and what are futures and options in gold, how do you trade it, and what drives the gold price, the inverse correlation and some of economic indicators that one needs to look at if you are an investor in gold. One also needs to look at fund positioning, wherein how global fund managers are positioning their assets and how is the global growth looking like. So these are some of the basic things wherein we will be looking at and possibly gauging where our gold price is headed for say next 3 to 6 months perspective. Let us start now. First and foremost, we need to understand why gold is important for investors. This is an asset class which really has its emotional value, its cultural value, its financial value derived from our history. This asset class has its emotional value because Indians, as such, have pride in holding or possession of this asset class. Besides, the one more reason you need to have gold as a part of your portfolio is because it is a unique asset. It is a very liquid asset. You can sell it anywhere. You can encash it, and plus it is a very scarce asset. You really have to dig lots and lots of mining in order to find gold. So it is a scarce resource. So as much as it is a luxury, it is also an investment. Besides all of this, you should the gold plays a fundamental role in any investor portfolio. So this is one of the situations wherein gold is an important role for investors. And the basic necessity why gold is really important, it acts as a hedge against inflation. So if you ask me why gold is important, all these points clearly has its own role to play, wherein it really acts as a hedge against inflation, and that is purely one of the reasons why gold is a go-to assets for any investor, irrespective of the price, and hence gold is required for investors to purchase in order to act as a balancing for the portfolio. This particular screen gives you the data of the basics of gold market. On the left hand side of the pie chart, you can see on the left hand side of the pie chart, you can see that some of the major gold producing countries. You can clearly see China, Russia, Australia, US are one of the top four producing countries. On the right hand side, you can see the global gold demand, in which almost 50% of the gold that is being produced globally goes into making of jewelry, which clearly states that the importance of gold in consuming is purely from a jewelry perspective, where almost 50% of the gold that is being produced globally goes into consumption and making of jewelry, which is followed by major purchases into bars and coins, and then followed by major purchases in by the central banks, and then at last, but not the least, ETFs also have a major component wherein 9% of the total gold production goes into the form of ETF. So this slide is to give you a perspective that some of the gold producing countries are plays a key role in the gold market, and which means supply and demand dynamics is an intrinsic part of the gold market, irrespective of the fact whether it goes into the consumption of jewelry, whether it goes into the consumption of bar and coins, or whether it goes into the consumption of central banks. We'll proceed further. Uh, we will directly hit the target, wherein we will tell you possibly what are the options that one can avail if you are in India, and what are the options available if you want to invest in gold as an asset class. The first and foremost that we as Indians believe that physical gold is one of the important part of the asset portfolio, and irrespective of the fact whether you do it for investment or consumption, the price is not a constraint. So one of the main reasons why Indians buy gold is in the form of jewelry, followed by coins and bars. So if you are a gold investor and if you need to buy gold, physical gold is one of the prime options that Indians consider as a part of their investment strategy. The second option that one can go for is in the form of gold accumulation plans, which is nothing but a part of digital platform which is offered by Google Pay, Paytm, PhonePe. And the gold that is being there on this platform is certified by MMTC PAMP, which is one of the biggest refiners, not only in India, but also across the globe. The third option that you can avail if you want to buy gold is purely from a long-term perspective. This is one of the good options introduced by Government of India, wherein wherein they have an open subscription for sovereign gold bonds. The recent subscription will start tomorrow, which is 9th of November, and it will end on 13th of November. The basic criteria that this particular investment holds true is because the investment horizon is much longer. It is for the term is for a period of 8 years, while there is a lock-in period of 5 years. And the best part of this investment is you get interest if you are investing in sovereign gold bonds. Vis-a-vis, if you purchase gold in physical form, you do not get any interest nor dividend. So this option is really one of the key options available for investors in India if you are really looking at investing in gold from a long-term perspective. The next option available to invest is in the form of exchange traded funds, which is nothing but ETF. This is an option which is clearly more liquid in the international forum when compared to domestic arena. Although ETFs get traded in India, the kind of liquidity that it enjoys in the international forum is much more than what it trades in India. So these options get ruled out. Last but not the least, if you really want to take benefit out of volatility in gold futures and options, the product that is available to trade on the MCX platform is possibly one of the ways wherein you can possibly remain invested in gold, get out of the benefit of the price volatility, depending on how you clearly understand the direction of the trade. So these are some of the key available options if you are a gold investor in India. And it is really from a diversification perspective that gold has to be understood as an asset class, not only for the purpose of investment but also for the purpose of consumption. This is for those who really want to trade in futures as well as options. The table clearly gives you a brief understanding of what are the products that are available to trade on the MCX platform. On the first side of the chart, it says gold, which the lot size for which is 1,000 grams. The tick size is 1 rupee. The profit or loss per tick is 100 rupees. The expiry date of the contract is 5th of the contract month. The delivery logic is compulsory. You need to understand all these basic parameters if you are investing or possibly trading in gold and take the benefit out of price volatility. If you trade in gold, you need to understand that is a compulsory logic based delivery contract. You cannot continue with the position on the contract after the expiry of the contract. There is a 5-day tender period. You need to get out of the contract if you are a buyer or seller of the contract, because if you don't get out the contract, you possibly have to take delivery of gold from the platform. So this is one of the important things that you need to understand if you are possibly a trader or investor in gold. The second option that is available if you want to trade in futures is gold mini option. The price quote that you see on the screen is rupees per 10 grams. The lot size of this contract is 100 grams. The tick size is 1 rupee again. The profit and loss per tick for this particular contract is 10 rupees. Again, the expiry of this contract is 5th day of the contract month. Delivery logic again is compulsory. Similarly, it goes for gold guinea and gold petal. The reason why I'm explaining you all these product details or product contract specifications is because for those who want to invest in gold, these are some of the products that are available on the exchange platform. If you cannot trade a bigger size gold, there are options available for other set of investors who have less money in comparison to what you require for trading bigger, which is 1,000 gram or 1 kg gold. And hence this is a product basket wherein you can possibly trade in gold, take the benefit out of volatility in trading gold futures as well as options. You really need to understand margins if you're a trader in gold. Just to give you an example, assuming that the last trade price of gold stood at 50,000 rupees per 10 grams, the lot size, that is the contract size, is 1 kg, which is nothing but 1,000 grams. The value of the contract would be nothing but last trade price of gold, which is nothing but 50,000 per 10 grams, multiplied by 1,000 grams, which will give you nothing but the value of the contract. This is the total value of the contract. And if you need to trade one lot of gold, the margin that you need to have in your account is close to around 10% of the contract value. In this case, 10% on 50 lakhs stands at around 5 lakhs, which clearly means that as an investor in gold, if you need to trade one lot in gold, you need to have at least 5 lakh in your account if you need to take positions in gold. Tick size and profit and loss per tick is also one of the key things that you need to understand as an trader, as an investor in gold. It is clearly nothing but lot size divided by quotation into tick size. We will just apply this in our equation. And the lot size that you can see for trading 1 kg gold is nothing but 1000 grams. The quotation that you see on the screen is for 10 grams multiplied by the tick size. The tick size for trading big 1 kg gold is 1 rupee, which means for every 1 rupee movement in gold price, the profit or loss that you can see on your account is 100 rupees. The understanding of margins and tick size is clearly important if you're a trader or an investor in gold on the MCX platform. The expiry of the contract also holds key significance, which means you clearly see on this particular screen. At present, the contract that is available to trade on the platform is December 2020 contract. The expiry of this particular contract would happen on 5th December, which means you will no longer be available to trade this particular contract after 5th December. Either you have to roll over your positions or either you have to square off your positions. Similarly, at one point in time, you have six contracts to choose from. Also, one of the key important thing is the most recent contract will have a lot of liquidity in comparison to other contracts. Hence, the clear advice here is that you should trade in the front month contracts rather than trading in the far month contracts. This is also one of the clear and important understanding that is required for a gold investor. What is the price parity that you see on the domestic exchange, and what is the price parity that you have on the international exchange? As you, I will explain this particular tabular form, which will give you a possible clear understanding how gold price is derived in India. The spot price, that, assuming the spot price that closed on Friday. On Friday, say the closing was $1,900 per ounce. The first thing that is required for calculation of understanding gold parity is nothing but cost, insurance, freight. Cost, insurance, and freight is added to the spot gold price of account. In this case, this is $1.5. The total adds up to 1901.5. Since we are talking about per ounce is nothing but close to or equivalent to 32 grams. We will multiply this $1901 into 32 grams in order to get the value of 1 kg of gold, which is 99.99% purity. The one that is that trades on the M6 platform is 995, which is 99.5% purity, and hence we need to convert this 99.99% purity into 99.5% purity. You can do the maths, which is shown on the tabular, and the actual value for per kg of gold stands at around 60,835 rupees. It is very simple. You need to multiply, because we are in India. We need to multiply the currency rate, assuming the last closing price of USD INR stood at 74 rupees for per dollar. You clearly need to multiply this particular values in order to get per kg value of gold. In this case, it stands at around 45 lakh rupees. The next component that needs to be added is clearly the customs duty. Customs duty is a duty which is set by Government of India, the value of which changes every 15 days. The calculation of which happens on the tariff value, which is given in the table alongside, which is 630 per 10 grams, which clear and at a duty of 13% is calculated on it. So which comes to around 6 lakhs 6,060 rupees. This component is added to per kg component, which gives you the landed cost per kg of gold. And since banks do all of this dealing, there's a cost that is attached to it. In this case, it is 0.1%, which is added to the total value of landed cost per kg. The final wholesale price per kg stands at around 51 lakh 12,955 rupees, which needs to be converted into 10 grams, which is 51,129. And you will almost have parity to the MCX futures possibly that trades on the platform. And if there is any difference, it gets sorted out over a trade period. So this is how you understand gold parity, and it needs to be understood in the context because India is one of the important gold importers, and how the price conversion happens once it lands in India is one of the important components if you are understanding, if you are a trader or investor in gold, because the price disparity or parity will possibly help you in understanding the discount or the premium that is available, that is there in the market if you really need to purchase or import that gold. What drives the gold price? This is one of the important set of events that one needs to understand if you are an investor in gold. One thing is for sure, if markets remain uncertain, people turn to one asset which is nothing but gold. And you have clearly seen that 2020 has been an year of uncertainty. The pandemic has created havoc across the globe, because of which the uncertainty has led investors globally to put their money into gold, and that's the reason wherein you have seen gold prices in the international market rallying from $1,500 per ounce to almost $2,000 per ounce at present. In the Indian scenario, from 30,000 mark to 50,000 mark has been a very fast ride, which clearly tells you that the impact of uncertainty clearly has an impact on the safe haven, and gold is one of the important safe haven assets globally. The point I want to make here is every world event, whether it be the election in the US, whether it be the Britain getting out of the European Union, whether it be any prize event, whether it be any geopolitical, possible geopolitical disturbances in any part of the globe, it clearly has an impact on the price of this asset class. Which means the key takeaway from this particular slide is if there is uncertainty, gold price goes up. If there is no uncertainty, possibly you will have all the risky assets going up. But in this case, 2020 has been an year of pandemic. Gold prices has gone drastically up. The returns is almost in double digit, 25 to 27% for 2020 year till date. And hence uncertainty is the name of the game as far as gold price is concerned, which clearly tells you that the gold and supply and demand dynamics has its important role to play in deriving any asset price, and gold really does not fall out of it. The supply and demand dynamics has played an important role in the pandemic. Although the supply has remained constant, the demand dynamics has really got has taken a hit in this pandemic, wherein the physical delivery of the commodity was almost impossible. Although a lot of investors globally have opted for digital method of having position in this metal, but supply and demand dynamics clearly plays an important role in driving the gold price. Last but not the least, the strength and the weakness of the US dollar is also very important to understand if you are an investor in gold. The influence and the direction of US dollar is directed by a lot of events. For instance, the US election also plays an important role in the direction of dollar. So any important event that happens in any part of the globe has an impact on dollar, and hence the direction of the dollar becomes important if you are a trader or an investor in gold. Just to give you a general basic that dollar and gold share an inverse correlation. We will see this in our next graph. The key takeaway from this particular slide is you need to understand that the direction of dollar clearly plays an important role in driving the price of safe haven. In this case, it is gold, and hence inverse correlation holds true for most of the time as far as dollar and gold is concerned. I've plotted this chart for dollar index and gold in order to tell our clients and investors that dollar and gold clearly share an inverse correlation. You can see this in the time period since March, and then it is October, November. The direction of the dollar clearly has a positive or a, say inverse correlation in comparison to gold. If dollar index goes down, possibly gold prices go up. So what I need to define as an investor is, if you clearly gauge and understand the direction of the dollar, it really becomes the piece of cake as far as the price direction of the yellow metal is concerned. The key takeaway from this particular slide is that dollar index and gold share inverse correlation, and if you understand this correlation perfectly, the price of gold is really easy to understand from an investor's perspective. This is some of the important indicators that one needs to understand if you're an investor in gold. Since we are talking about US, we are talking about other developed economies, there are some economic indicators that one needs to have a keen eye on. The first important indicator that really needs to look at is a consumer confidence number, which gets released from the US. The second important indicator that one needs to look at the GDP number, which gets released from the US. For that matter, it can be from European Union, from it can be from Japan. Any important number which signifies the strength or weakness of an economy is an important number, and it clearly has an impact on the price of gold. The third important indicator that one needs to look at is the non-farm payrolls. This particular indicator tells you about the employment scenario in the US. The fourth important indicator that one needs to look at is the central bank meeting from the US, central bank meeting in the Euro area, central bank meeting in Japan. The reason why central bank meetings are important is because of the policy stance that is adopted by the central banks. Just to give you a case wherein 2020 has been an year of recession, and central bank has ensured that whatever it takes to stabilize and bring back normalcy and growth of the global economy, they have almost infused a good amount of liquidity in order to bring in the balance and bring back growth to the world economy. So 2020 has been a year when central banks have not remained silent. They have come to the fore. They want to stabilize global growth, and hence they have infused good amount of liquidity to bring back stability and normalcy of the global economy. The data impact clearly has an impact on the dollar, and we have clearly understood that dollar and commodity shares an inverse correlation in our previous slide. Fund positioning. This is one of the important indicators for those who invest in gold. This is an indicator which clearly tells you about accumulation of gold in a portfolio from an international fund perspective. This is a data which is released by CFTC, which is nothing but it tells you about big fund managers about being bullish or bearish in gold. You clearly see after 2019 and for most of 2020, gold, the accumulation from a fund perspective has clearly been stable. Although the graph looks like a bit on the downside, but 2020 has been an year of accumulation for gold, and this chart clearly tells us that funds globally have been net buyers of gold, and they will continue to be buyer of gold, taking into consideration the circumstances surrounding the global economy. This is some of the growth global GDP numbers, which gives you one screen look of how all the countries across the globe will fare in 2020 and what is there in 2021. You can clearly see that 2020, almost all the economies, right from OECD nations to US to Eurozone, UK, Japan, China, almost everybody except China has been trading has been the growth that you can see in this particular countries has been negative. However, there are some green shoots of recovery that is possible in 2021, which means 2021 would possibly see some growth happening across the globe, and 4.7 is what the prediction from the OPEC nation. Uh, the reason why I'm telling you about this particular trajectory is because if global growth does not happen the way it needs to be, I think gold is really one asset that investors across the globe continue to increase their holdings as a part of or a portfolio allocation, and increase their reserves possibly in allocating gold. And hence, understanding global growth is really keen and necessary if you are an investor in gold. ETF, exchange traded funds, is one of the important ways wherein global investors continue to pump their money into. It is clearly seen that almost in 2020, gold ETFs have added almost 1,000 tons in their holdings, which is for the first time ever after 2009, which clearly indicates that investment demand for gold globally has been increasing and rising, and this will continue to be a part in 2021 as well, because the markets remain uncertain. There is an excessive amount of liquidity infusion by central banks, and ETF continues to be a major source of investment for gold investors. And it is happening in 2020, and it will continue to happen in 2021. On the right hand side of the chart, you can clearly see the last bar on this graph is nothing but 2020 year to date price performance of gold. It has been the best year in terms of returns. In the international arena, gold has given 26% return in 2020 year to date, while in the domestic markets, gold has given returns of 31%, taking into consideration the performance of USD INR. So this has been almost the best year out of last 7 years, wherein gold has given double-digit returns. And since we are almost left with 2 months of 2020, and since it is a Diwali in India, the purchases would possibly be taken into account, and gold prices would possibly rise further, taking into consideration the Indian demand. But the main fact that I want to highlight you is that 2020 has been an year of uncertainty, and investors have flocked to gold, because of which the returns that you can see in gold has been there in double digits, and there is still more room for gold prices to increase, because for Indians, it is a need and desire based investment, rather than having this particular asset in their portfolio from a return based perspective. So irrespective of the fact whether gold is at 50,000 or whether gold is at 30,000, Indians will possibly continue to purchase and accumulate gold as a part of their portfolio, because it is purely from a need based perspective. Last but not the least, we want to understand whether it is the right time to buy gold this Diwali or not. The factors that we have discussed in our previous slides clearly tells us that globally we are in a state of recession. If you see the price of crude, it is almost been faltering in past few trading sessions, and there is talk of second wave of coronavirus possibly in Europe and some parts of US, which will possibly lead to falteration of demand for crude. It clearly tells you that markets will remain uncertain in coming months, and hence, in times of uncertainty, gold is the go-to asset for investors. The other point that we stressed on is the easy money policy of the central banks. I think, irrespective of the fact whether what is the outcome of the election in the US, the clear fundamental support for gold is in the form of the excessive amount of liquidity push given by central banks, which is nothing but going into an asset chasing for higher returns. And gold clearly holds true in this particular scenario. Although 2020 consumer demand has clearly taken a hit because of logical as well as political constraint, I think this will possibly ease in the near future. Irrespective of the fact whether consumer demand is hurt or not, we have clearly seen that investment demand of gold into ETFs continue to rise in 2020, and it will continue to rise in 2021 as well. So at present, we are in India. 52,000 is what gold prices are currently trading at. Irrespective of the price, whether you are a buyer of gold for physical possession of gold or if you are an investor of gold, I think one should have gold as a part of investor portfolio. The allocations might change depending on your risk appetite, but it is advisable that if you have 100 rupees in your portfolio, at least 10% of it should be allocated in gold. The clear message is that whether gold is at 50,000 or whether gold is at 60,000, it needs to be part of your portfolio. And hence, no price is small price, no price is a big price as far as gold is concerned. You need to continue to accumulate gold at all the levels. Thank you very much. Now we will take questions from the participants. Okay, can we have questions from the participants now? How much percent portfolio should have gold? I think I clearly mentioned that if you have rupees 100 to be invested, at least 10% of it should be invested in gold. And taking into consideration the uncertainty, I think that the allocation should be increased to at least 15%. I think since we have previously hit 56,000 very recently, I think gold prices at 52,000 mark now. There is still more room for gold prices to increase. I think 56,000 is possibly the next gold price that you can see. It clearly depends on the global uncertainty. If the global uncertainty continues to rise, you will see gold prices continue to rise. Do we have any more questions from the participants? Sir, there are equity experts possibly that will tell you more insight about Gland Pharma. This webinar is purely focused on the gold price and the direction. Okay, do we have any more questions? If there are no further questions, we can possibly wind up this webinar. And since I can see a lot of participants have saying Hindi, we will possibly have a complete webinar next time in Hindi. Yes, please. How much gold do you think would be the right to buy? So there is nothing right and nothing wrong when you are buying gold. It depends on what kind of investment horizon you're looking at. What is the kind of investment that you have as a in your portfolio, and accordingly you decide depending on your risk appetite how much should be allocated. But ideally, it should be somewhere between 10 to 15%. Is there chances to go down gold prices? I think if gold prices has to go down, the base that stands at close to around 49,000. So if you see anywhere the gold hovering around 49,000, that is possibly the best price that one can get in this particular times of market uncertainty. Okay, there seems to be no questions from the participants. We can wind up this webinar, and we will have some more webinars. Possibly next time it would be in Hindi. Thank you very much for all the participants for listening to me patiently. We will continue to have all these webinars time and over again, depending on the topics that one would be interested in. So, if this time it would be gold, next time we will possibly talk about crude, the markets, and where it is headed. Thank you very much for your participation.